Graham, let's first talk about how we've been thinking about energy markets over the past few years. The Antipodes global portfolios have been overweight energy for the last 6 to 12 months, led by exposure to US oil and natural gas producers. And this has been a key contributor to alpha during recent market volatility.
That's right. As you know, we had been building energy exposure going back a couple of years now. The genesis of that thinking was really the observation around the broader capital cycle that was likely to play out in oil and gas. And it's an industry, of course, that is very capital intensive. And if you look at the pace of CapEx since its peak in 2014, by the end of 2020, we were looking at an industry that had dramatically underinvested in growing its production. And there's a few reasons for that, which we can go into, but the inevitable consequence of that was that we would likely see a price cycle, in other words, rising energy prices. The rationale behind it, how did we get to that position? It was a combination of factors, really. The industry, sort of by the end of 2020, was in a pretty dire situation. There was enormous balance sheet leverage. The track record of the prior 5 to 7 years of returns was pretty bad. We had a reconstitution of the shareholder base that was insisting on a very different capital program amongst listed companies, one that would prioritize debt reduction and the payment of dividends over growth. And at the same time, we had the rise of ESG overlays that were running the ruler over everything that the fossil fuel industry was doing. All of those things really have conspired to raise the hurdle rates that are required for oil and gas companies to invest in new capacity. And indeed, you've seen the industry spend at really only maintenance levels of CapEx for the last couple of years. And whilst that sounds adequate in itself, maintenance CapEx is really only the level of spend that gets you to declines in oil production rather than increases. And there are various scenarios out there as to when fossil fuel demand will peak. But in our analysis, we see demand still rising until the latter part of this decade. And there is a requirement to grow production to support that. The outcome of that, of course, is we've now seen a very significant price cycle. Oil prices have moved up dramatically in the last year. And of course, the conflict that's now underway in the Ukraine has only added fuel to the fire, given the importance that Russia plays in the global energy system.
And Russia really does have such an important role in energy markets globally, but particularly so in Europe, doesn't it?
Yeah, that's right. I mean, Europe is very much dependent on Russia for a significant part of its, particularly its natural gas supply. Europe, just to give you some round numbers, consumes about 500 BCM of natural gas a year. About 150 billion of that BCM of that comes from piped gas from Russia, and then another portion on top of that from liquefied natural gas, LNG. So Russia is very important, and there are certain countries where Russia provides as much as 75 to 100% of gas supplies for certain countries within the EU, mainly those in Eastern Europe. So it's a critical source of supply, and has given the conflict that's now underway, it's become certainly a bargaining chip between the EU and Russia. So we sort of need to be very conscious of the potential fallout effects of any change in policy on either side of the fence here.
And Graham, it's not just energy prices that have moved due to the crisis in the Ukraine. Commodity prices broadly are rising. Russia, Ukraine and Belarus are not only large exporters of energy, but are also important suppliers of several commodities. So can you take us through the wider implications of sanctions against Russia and the impact to Ukraine?
Yeah, that's right. I mean, Russia and the Ukraine and Belarus combined are very important export markets for a range of commodities, not just oil and gas. We see things like aluminium, nickel, steel, fertilizers, sunflower oil, various grains, for example. All of these markets are potentially going to be impacted by the sanctions and inability to get this product to its intended export destinations. We have seen, for instance, a significant move up in palm oil prices. Palm oil is a product that competes with sunflower oil. Sunflower oil, about 50% of world production comes out of that part of the world and is likely to be impacted. And so we've already seen flow-on effects in the price of palm oil over the last several weeks. We've seen also significant increases in the price of potash, where Belarus is a major exporter of potash. There were already export restrictions that were in place ahead of this conflict, but the inability to transport those tons through Russia has made it almost impossible for that product to reach market. So there are some wide-scale effects here that are playing out and will be felt through a number of product and commodity markets in the months ahead.
Can we go back to that original thesis and why we had been overweight energy before the current price surges and talk about our longer-term view of the energy market? So looking beyond what we're all hoping for, which is, of course, a peaceful end to the conflict in Ukraine, natural gas in particular is an area we've been positive on even as the world decarbonises.
That's right. So it's worth mentioning that we have long held the view that natural gas is an important stepping stone or transition fuel in the path to a decarbonised economy. The reality is, for large parts of the world, the ability for renewables to provide baseload power that is consistent and reliable simply today does not exist. And there are lots of countries that want to get off the use of coal and see gas as a mature, stable, much lower carbon emission option in order to do that.